Welcome to the Gower Crowd podcast, syndication in the digital age, where today you're going to be hearing from one of the brokerage industry's top leaders, Jay Olshonsky, who is president and CEO at NAI Global. Hello, Adam Gower here, and today's show comes about after I read an article in Yahoo Finance about the timing of a wave of distressed real estate assets likely to hit markets. The article talked about this wave coming in 9 to 18 months from now, so Q2 21 onward. And this is consistent with what other guests on the podcast have predicted, including Ethan Penn at Mosaic Real Estate Investors, for example, Greg Freedman at BH3, Willy Walker at Walker Dunlop, and others. And so I figured it was time for an update and to hear from the brokerage industry, hence the call to Jay Olshonsky. Today's show is more focused on market conditions and predictions than it is on digital marketing. So, more focused on how to find opportunistic deals and when to expect them to come along, as well as how to compete against the massive capital out there just waiting for the same opportunities. To find a vast selection of similar resources, go to the Gower Crowd website and hit the COVID-19 resources link top right. And if that's not there anymore, when you listen to this podcast, you'll find all those same resources under the Raise Money Online tab on the menu bar. And while you're at gowercrowd.com, check out some of the free training links that you'll see just about everywhere. You are guaranteed to learn at least two things if you click on any of those links. One, you'll learn whatever it is that the training is about, of course. And two, you'll learn how those links are lead generation forms that trigger automated emails and other nurture sequences in follow-up. They are the exact same systems that you get working with us here at Gower Crowd for capturing prospect contact information and for then following up with automated relationship nurturing systems so you can raise money online from prospects you have never met. Right? It's all there at gowercrowd.com. All right, now to find out where to find opportunities during the current economic downturn and when you might expect them to come along with my guest today. Great pleasure to introduce you to Jay Olshonsky, President and CEO at NAI Global. Jay Olshonsky, President, Global President no less, and CEO at NAI Global. Thank you so much for being with me today. Now, today is a very important day in my house. My two little boys are, for the first time ever, sitting at their screens learning. Right? They're at school, distance learning, for heaven's sake, what a wacky thing. Plus, in England, I heard on the radio today, and I'm in the United States, in case you were wondering, in England, the A-levels are being, the results of the A-levels are being awarded. Those are the main exams that get you into university. And so in honor of all the kids who are studying today, starting, or getting their results, I have an exam type question, if you'll let me, and it goes like this. I read an article, it's how we connected, on Yahoo Finance, and this is what it said. Commercial real estate veteran, that's you, right, expects a wave of distressed property asset sales comparable to the early 1990s and post-GFC. Question, compare and contrast.
Okay, well, let's start with, anyone that has been in commercial real estate long enough to remember whether it's the 1990s or 2009, certainly understands what, let's say, disruption in the markets can have an effect on properties, property values, lending, debt, etc. So unfortunately, we have had COVID-19 that has hit globally to where people have had to shut down their economies, shut down their restaurants, shut down their stores, shut down their businesses, work from home. And in essence, we also have a problem where, not just in the United States, but we're going to focus on the United States, that people also have been, not having the ability to pay their rents, whether they're a tenant, an apartment dweller, a mortgage holder, or someone living in a house or, an office building. It is so widespread that at some level, now that we're 3 months past this, we are going to have an enormous amount of forgiveness, which will lead to debt forgiveness, which will lead to foreclosure, which will lead to receivership, which will lead to new properties being managed, sold, etc. Mainly because at some point, most of these deals are financed with non-recourse financing, and people are going to have to make a decision, can I hold on? And why this is so different than 2009, the best example I can give you is we had an economist from CoStar, and I will quote him because I give him credit for this, and he basically said, this is at least 20 times worse than 2009. So if you just take that volume and you look at it that way, if you really think of 2009, it was really starting in the mortgage-backed securities and housing, and then it spread to the mortgage-backed securities in commercial real estate. This is spread to everywhere. This is the local bank. This is the biggest banks in the world. These are the biggest players in the world that unfortunately are going to be in a position where, this is every hotel in the world, or whether it's in Park Avenue or whether it's, down the street on the interstate. These are drastic aspects that have hit our economy. And, unless something like a vaccine comes where people will, quote, get back to normal, there's no way of stopping the train that's already left the station.
So that's interesting. Actually, the 20 times worse
20 times
is a pretty bleak outlook, because I remember the global financial crisis last time, and I would say that 10% worse would have been catastrophic right at the time. So 20 times worse. But let's just assume for a moment that there is a vaccine. What are the lingering effects? Because in the article in Yahoo Finance, you project that the distress will come through within 9 to 12 months.
Right.
So I'm not going to hold you to that, obviously. But premised on that, what happens why 9 to 12 months?
All right, well, let's start. Well, first of all, right now, keep in mind, if you say we jumped into this, unfortunately, in March, and then, by the time people figured out what was going on, it was April. And then all of a sudden, everyone said, all right, well, my business is closed or I'm shut down. And then everyone started asking for debt relief or rent relief. Some people paid, people that had the ability to pay, some people didn't. So depending on where, let's say, the property owner is sitting, they're in really good shape on some of their properties, or I've heard in some cases on retail, in New York City, I talked to someone that said they have a 5-unit retail building in Manhattan, not one tenant paid the rent. So of course they called their lender and they said, okay, well, I don't have my rent, so I can't pay you. What can we do? And the lender gave them, 3 months. So now we're coming up on those 3 months. So now, we're essentially, the lenders now have to make a decision. Are they going to work with these property owners? Are they going to foreclose on these property owners? What are they going to do? So that's why it will probably take another 3 to 6 months for them to figure out the debt holders on all these properties. Am I going to go down the legal process, take possession of the property? And keep in mind, this can be a bank, this can be a CMBS servicer, this can be, a private debt holder, this can be a mortgage REIT, this can be all kinds of different people holding that paper will ultimately have to make a decision. Now, so I also think a lot of them are thinking, should we sell the actual notes of the properties and not go through the foreclosure? That again would delay the process. So that's how I kind of come up with my, let's say 12, 6 to 18 months is sort of the range when some of these properties will start happening. Now, add one more thing. In the United States, most of the courts have been closed. So if you're going to go the eviction route or the foreclosure route, you're going to have to get in line. So I think all those elements really add up to why you're not seeing a wave of properties today, but you potentially will see them, in the near future.
And of course, the work that's been done with lenders currently or to date, it's not forgiveness, is it, Jay? It's deferral.
No, it's
So this is
deferral.
just backing out instead of taking a loan and calling it past due after 90 days, is your example. They're stalling, basically. And then,
Right.
of course, the big question is, look, even if you do take, so let's think through this actually a little bit from a bank's perspective, from a lender's perspective. If you do take a property back that has tenants in it that aren't paying rent, why are you any better off than the landlord, the current landlord, to extract those rents? Similarly, what about a note buy? If you sell, you're going to take a loss. Now, note buy, that's where opportunity knocks, right? Would you say
That's the first bite. Yep.
is
Yeah.
is
Yeah, no, there's no question that the first bite is going to be there. Like let's just use a simple example. You're a regional bank, let's say in Southern California, and you have 100 loans that are now deferred, for 60, 90, maybe 120 days. And then you determine that 50 of those loans are never going to get any better. It might be a whole lot easier just to take those 50 loans to market and see what the private capital is willing to pay to buy those loans, at what discount. Now, could it be 20 cents on the dollar? Could it be 50 cents on the dollar? Could it be 60 cents? I don't know that, and because there hasn't been enough distressed loan sales to actually say, okay, well, this portfolio of 50 loans sold at this discount. But it's coming. It's definitely coming. Yeah. And the private capital will step in, because there's so much money out there, and then they will take it through the foreclosure process. They'll figure out maybe they can make money at it and go from there.
So actually, Jay, so that's a really important point. And something we chatted about before we started today was the amount of liquidity that is in the market. This is a major difference between this time and last time, is that there's just huge amounts of cash just waiting for this kind of opportunity. Does that demand and that liquidity not put a floor on the extent to which the market can drop this time compared to last time?
Yes, it does. The question is, where's the floor? That's the $99,000 question. It's like, I literally got 2 emails this morning from people that say, hey, I know you guys are specializing in depressed real estate. I'd love to buy some. We've got plenty of cash. And, they said, what would you recommend I do? And one of the things that I recommend people do, and this is something I learned in 1991, if you start buying, once you can start buying, and even though the prices might go further down, you keep buying as the trough gets lower, and then you stop buying once the trough then corrects. Because some people are good at it, but I'm not really good at it, and most people are not really good at telling what the floor is, and that's my point. But right now, a hotel owner called me a couple weeks ago and said, I have a hotel, it's worth about $10 million. I said, worth $10 million when? And they said, well, that was my last appraisal. And I said, is it open? They said, no, it's closed. I said, well, they said, can you value it for me? And I go, sure, we can run numbers based on your last occupancy report and figure out what it would have been worth on March 1st. But if it's closed, I don't know what someone would pay you for it. And long story short, he kind of said, well, what do? I got like $6 million of debt on the property. And I said, well, 2 things. One, you might want to actually get bids on it to figure out what someone will pay you. Maybe someone will pay you 7. Maybe someone will pay you 4. And then there's another ugly thing out there that everyone forgets. And you said you had worked at banks, so you'll understand this. And a lot of people forget. There's this ugly thing called debt forgiveness tax. And whenever you have debt forgiveness, you then get to bankruptcies and workouts, and then all other ways of handing properties back for investors that invest in the property. And whether that's an individual investor or a large-scale investor, there's so many issues going around right now. There's definitely a floor on capital, and certainly you can do things like some of the 1031s with the zero returns to offset some of that. but it's still, we haven't seen anything coming of any significance yet. And it's just, and I don't know where the floor is. If I had to guess a floor, I think that in the 30 to 50% to value is I think private capital steps in at that number. But, I can remember in the 90s, people were paying, I remember selling an office building for $10 a square foot that was valued at 100. So at some level, I don't know if it's going to get that bad.
Well, the other thing is, though, Jay, I was asked when I was at the bank during the last crisis, last downturn, frequently was asked by investors, how much discount are you giving? And really the answer is, it really depends on the asset. If you've got a cash flowing asset, even if it's limited cash flow, it's going to do a lot better than some bare land, right? That's costing you,
right.
That's got no value, right? It's costing you money. There's no income. You're paying insurance, you're paying property taxes, right? That's just cost. So I remember land we were selling for 10 to 20 cents, at the low 10 cents on the dollar. But anything cash flowing, 90 to 95, 98%, depended on what it was. So with that in mind, let me ask you this. So there have been, again, in this article, there are a couple of asset classes that you mentioned, at least that were mentioned. One was retail, one was hospitality. So what I've noticed in the news recently, and it's certainly not life-saving, but it implies recovery in hospitality has now gone from 20% occupancy is now up to 50%. So we saw hospitality drop off the cliff and is now slowly pulling back. What about other asset classes, specifically multifamily that everybody talks about being bulletproof, and offices, for example, and industrial? Tell me something about how those are different, how you think things are going to pan out over the next few months.
Well, let's actually start with hospitality quickly. One thing to remember, and you just hit on it, the aspect of hospitality is where the hotel or resort is. At some level, if you're in Las Vegas right now, that's a much different animal than if you have something, let's say a 5-star hotel in New York City. And also, if you can drive to it, you have a much better chance of recovery versus something that you were dependent upon convention business that was travel related, or, so our resort business that was travel related, meaning, like you had to fly there to get there. So hospitality will definitely improve with the driving first. If you then think of the retail wasn't in great shape coming into this whole thing. And now, you can't even go out and eat a pizza in a pizza restaurant in most places, that's never happened. Keep in mind, some of these things have never in our lifetime happened. I think I've gone through 4 economic recessions or maybe 5, and every time you could get on an airplane, you could take your family out. If you had $20 left, and that was your last $20 because you just got laid off in 2009 or 2008, you could still take your family to the pizzeria and order a large pizza and a few drinks and feed your family for $20 and have.
Isn't that incredible?
I know.
It's really incredible. You could go and see a movie. Movie theaters did well.
Well, that's a whole nother. It's like, right? I'll pay, I live in New York City. I used to pay $36 to go to the movies normally with my wife. So would I pay $25 to watch the first run movie that's out on Netflix or on Amazon? Of course I would. So, that will change completely. Now, you raised multifamily, which traditionally has been bulletproof. Now, I can't remember any time in my lifetime where people weren't paying their rent on an apartment because they had lost their jobs in massive amounts like people have, or they were getting, whether it's $400, $600, $800 from the US government a week to support themselves during this off cycle. And the prospects of the next employment is not there. Plus, the governments have said you can't evict them. And then those have just been extended. So a product type that traditionally was bulletproof, multifamily, I don't see how that's going to also be unscathed in this. And certainly, there were other things in multifamily in certain areas. And I think I could use downtown Los Angeles. I certainly could use Nashville, where you had oversupply of Class A apartments. So if you can't afford to be in your Class B or C apartment because you can't anymore, you're not moving up to the Class A vacant apartment in some of these new cities. So multifamily will always be better than most assets because people have to live there. But I don't think it goes unscathed in this down cycle. Now, office is an interesting one. Office, I read something recently that said maybe it'll go to 10% of people work from home from where it was kind of like 5% coming into this. And at some level, I think there are a couple good signs here. Facebook actually leasing 750,000 square feet in New York City for the future.
Did you broker that, Jay?
I did not, unfortunately.
Oh, what a shame. We wouldn't be talking today if you had.
No, we'd probably still be talking, but no. Is a good sign of a company that certainly could have all of their people work from home. And they've said most of their people can work from home for a long time. They're making a pretty good bet that things will get better. And keep in mind, things always get better. Nothing lasts forever. I can remember in 1990, we had enough office space, for the rest of our lives, and then they kept building and things got better. Even after 9/11, I was in Washington, D.C. then, and, certainly New York and Washington are much better than after 9/11 and times like that. So, this too will pass. It just will take time, and it's a question of how long and how deep it will get. And now you mentioned industrial. Let's touch on that.
Sure.
I don't know if you saw the news this morning, but the news this morning is Amazon's thinking of either buying Simon or buying.
Yeah, I did see that. That's really interesting, isn't it?
So, at some level, if you think that through, it's funny, I commented to my wife and she said, so the Nordstrom's that might be empty is going to become an Amazon distribution center. And I said, potentially, especially if it's close to a major metropolitan area and the zoning will allow for it and the use of the building will allow for it. But I think it's a very creative reuse of retail. And certainly we've seen big box retail go to different, whether it's medical or things like that. It
is interesting. Let's talk about it for a second because it dramatically changes the makeup of a mall, right? Instead of walking into a department store, now you've got a boarded up thing with a distribution center behind it. When I was building movie theaters, it was a condition of our lease that certain tenants stayed in place. In fact, actually, people made it a condition of their lease that we stayed in business, right? So it's a fundamental shift, and this is important. Actually, it's a fundamental shift in the way that we will recover from this downturn. Is that certain asset classes are going to fundamentally change, right? Hospitality, even offices, and we've talked about that, but instead of densification, right, inside the office, more and more people packed into smaller areas, that people will spread out even inside offices, right, to take it because they need more social distancing, etc. Right, so just how do you think overall that's going to impact?
Well, it will have an impact, but keep in mind, and we're seeing this already. You're seeing people some that are doing it correctly and some that just don't care, already saying, you know what, I want to go out. I want to get on a plane. I want to go swim in a pool. I want to go back to the office. There's no question that there's things that are lacking in not being able to be around coworkers, around people to collaborate with, customers, clients. I mean, I used to travel 70% of the time. I don't travel at all now. And in a certain regard, that will come back, but it won't come back until the customer and I feel safe that getting on that plane will not infect him or her or me. And so that's where, but keep in mind, that will be time. And we're not talking 10 years. We're talking hopefully 2, or a year and a half, or even sooner, depending on which. That's the other thing. as much as I'd like to say we all watch CNN or Fox or other, none of us are infectious disease experts, so we have no clue on what's really going to happen, including some of our political leaders. So it's hard to really make judgment here, but the schools, like you said, need to reopen. People need to get back to work. And I hate to make just broad statements that it'll never be like it was. The question is, and this is what we're focused on, is how much damage and opportunity will be done in the next 1 to, let's say, 3 years.
Tell me something about NAI Global, Willy,
Sure.
because you have, we've talked a lot about your prognosis for the future, which is great, but presumably you have a lot of even if it's anecdotal, you have a lot of insight into what's going on in the world by the type of business that is being generated internally. So you have two types of customers, just as I do. You have people that want to buy, right? That they come to you and they want to buy. And then you have people that want to sell. Tell me something about what you're seeing internally in terms of trends and how those trends have been changing over the last few months since the beginning of March.
Sure. Well, NAI Global is the sixth largest brokerage firm in the world, and we have lots of good competitors that are bigger than us, and we have lots of good competitors that are smaller than us. One of the things that we're unique in is that each of our offices are independently owned and operated. So we're very global, but at the same time, we're very, very local. And at the end of the day, no matter what technology and no matter what you want to say about changes, there's always going to be a property. It's always going to need local attention. It's always going to need local knowledge. So we try to marry the global skills along with the local expertise. And that's really our differentiating factor. And a lot of our member offices have been members for, some cases, generations. And it's really quite unique. We have, well over 7,000 people globally. Most are in the United States. We have close to 400 offices. So we see different areas in different aspects. We also have tertiary and secondary markets. So we're not just in what I call the NFL cities. We are in the NFL cities.
The NFL cities. I've never heard that.
Yeah, but we're also, we're in, Biloxi. We're in, Fort Collins, Colorado, along with San Francisco and New York and Atlanta. And, we'll be like in Harrisburg, Pennsylvania, where people live there, people work there. We're in Sacramento, which is a big place, but it's not the biggest city in California. So that's a big difference. So what we're seeing right now, and I hate to say it, is we're seeing that, what I call that pause. We're seeing that leasing activity has dropped just because people are trying to figure out either work from home or when do I go back in, and so the only leases that are getting done are leases that were in the pipeline or leases that had to get done or renewals that had to happen. You're seeing very limited new leasing, and you're seeing some people say, well, you know what, I don't need as much space, so maybe I'll take less space. You're seeing that. Investment sales have also come to a grinding halt, mainly due to, one, there's not a lot of product being put out onto the market right now because there's a disconnect between what the seller thinks the property's worth and the fear that someone will come in and offer 50 cents on the dollar, even though that might be the right market. So investment sales has dropped off. And then it depends. We did have one transaction that we did recently that was with a large retailer that made a decision to sell their industrial distribution building on a sale leaseback in order to raise cash. So there are unique deals that are happening too. So it just depends. And then we are seeing some depressed real estate come out. We have some of our member firms have already gotten receivership opportunities, which is the beginning of the foreclosure. We also have some of our hotel receiver companies within NAI, already seeing some hotels that they want to be received. And that is the beginning or the baby steps towards the foreclosure, because you have to have receivership, you have to have management, you have to have leasing, and then ultimately sale at the property level. If someone's going to take a property back. We have had lots of people also contact us about potential note sales, and we've been contacting a lot of banks talking about that.
Buyers or sellers on notes?
Oh, we have I'd say it's 20 to 1 buyers. 20 to 1. Now,
Yeah.
we tend to not do a lot of work on the buy side, and that's really for one fundamental reason. Not too many buyers like to pay you, and not too many sellers like to pay buyer brokers these days, because essentially there have been major shifts in technology on the selling of properties that you don't need to have the buyer exclusive as much as you need to have the seller exclusive, because essentially, whether it's 10X or whether it's Real Capital Markets or different, or Crexi, or some of these firms that specialize in technology-based product, software as a service to sell properties. We do not sell any property that we work on that is not using one of those type companies, basically because it's process-driven investment sales. And how do I know that you're not going to be the buyer of a building? And as long as it gets in front of you, you could end up buying something in New York. I have no way of knowing you. Just because you're in California doesn't mean you wouldn't consider it. So that's the big area. But I'd say it's 20 to 1 people that want to buy versus people that want to sell right now.
And you are looking actively for sellers, right? To
Yes,
represent sellers like banks, etc.
We look to work with owners. The best way to think about it is we work with owners or occupiers who own buildings, or banks or servicers or other people, mortgage REITs that will be potentially taking back properties. Yes. Okay. And we have a lot of expertise in that, because we really had a lot of tremendous growth out of the 2009 fiasco. And essentially, one of our sister companies was in the special servicing business. And at one point, we were doing 300 to 400 sales a year just for one special servicer when we were coming out of 2009. So we have licensed receivers in all 50 states. We have management leasing capabilities in basically all 50 states. And also wherever we don't have coverage, whether it's through SIOR, CCIM, or even overseas, Royal Institute of Chartered Surveyors, which I'm a member of, we pretty much can help people anywhere. So, our approach is, look, just we want to help you. If there's something that you have for us, just tell us what you want us to do. But we don't do buy side, because most people don't want to pay me a monthly retainer to do buy side. But that's not to say we wouldn't do it in the event we thought we could actually do a good job and make market fees on it.
Now, we talked about this a little bit earlier before we started, was the impact of crowdfunding to the extent that there is one. And last time it was prohibited for sponsors to generally solicit, to find capital from anybody that they didn't otherwise know. And we've also talked about the amount of liquidity that there is in the market this time. If you find lenders who want to sell notes, how is NAI going to seek out a different type of buyer than they did last time, perhaps through the crowd? Or are you seeing buyers who are being funded by small investors that never had the opportunity to invest in distressed real estate before?
Well, the answer to the question is we're not seeking out one specific type of buyer versus another, and we're not eliminating one specific type of buyer versus another. One of the nice things about selling either a note or a piece of real property today is the amount of vastness that you can market the property to the potential buyer pool. The group that we use, which is Lightbox Real Capital Markets, they maintain a buyer database of, close to 75,000 or 80,000 individuals that make up note buyers, crowdfunding companies, institutions, private capital, and then you can slice and dice who you want to target it to. But we don't use the assumption that anyone is a bad buyer. We basically take it out to everyone, and if a crowdfunding group came along and made the highest bid, we would run it through the normal process of, making sure that they had the ability to actually do the transaction. But we would do that whether it was an institutional real estate owner, that they had the funds available. So we kind of look at it as this is a marketplace, And essentially, the number one call I get is from individuals that are essentially sitting on 25 million, 50 million, or $100 million. Just like you, some of them sold everything in the last 5 years, and they've been, because keep in mind, pre-COVID, we knew we were at the top. Post-COVID, we just didn't know the cliff was going to be so steep. So things were getting a little frothy, to begin with before March of this year, and we were all kind of looking at it thinking there could be a down cycle. So we just didn't know it'd accelerate this quickly.
Are you actually seeing any buyers who you are aware of that are crowdfunded?
Not recently, but that's not to say, and as you and I were chatting, I think, at some level, to put together a crowdfunding fund, where you're going to invest in, depressed real estate when it comes available, does allow, let's say, the smaller investor to get involved in something. If the management of the fund says, okay, we're going to buy, between 30 to 60% on the dollar and try to dollar cost average that at 50%, give me your $5, $10, $15, $50,000. I really think that is a good investment where, in a certain regard, especially if you go with a group that has some experience in this, you can look at this and go, okay, well, I'm essentially buying the real estate a lot less expensive than I would have bought it pre-March. So one side of me says, I think it could be a wonderful place for people to raise funds, and it could be a pretty easy way for people to raise funds, and then have a strategy that says, okay, this is what we're going to invest in. And I think that you would know better than I would. I would think there are people out there that are thinking exactly that. And then the question comes in, how competitive is it going to be? And the other thing I think a lot of firms need to do, you need to stick to sort of a plan. I got a guy called me and said, I got $100 million. I want to buy something once it's 40 cents on the dollar. I said, well, what do you want to buy? Where do you want to buy? Who's going to manage it? How are you going to have any expertise to take it to make it a profitable investment? So I think some of the crowdfunding firms also have the expertise in the management and to actually asset manage and then run these things through.
Yeah, and plus, of course, you can diversify across a range of investments as well, instead of plonking it all down on one. So let me ask you one last question, because I've just noticed, I can't believe how fast time has flown since we've been chatting. I do have 3 sign-off questions that I ask all of my guests, but we'll get to those in just 1 second. Let me ask you this first. If there are no buyers currently that you've seen who are crowdfunding, and this is a totally self-serving question, I'll tell you that right now, are there any that you can think of who should? And I ask that because or who would benefit from it? If there's so much liquidity, where are they getting their liquidity, and will they run out, right? If the spigot really opens up in 9 to 12 months, they'll regret not having sought alternate sources for capital.
I certainly think, if you go back to product type, that I can tell you there's all kinds of people that are raising funds for hospitality and hotel. So I think anyone that has any expertise in crowdfunding, either with a hotel, teaming up with hotel buyers or things like that, I think that's an area. I also do think there will be some aspects of multifamily, and I know there's been crowdfunding in multifamily from the point of view, just because, ultimately, look, this will correct. And as a good old friend of mine in Washington, D.C., who owned 4,000 apartment units, used to always say, in his whole lifetime, he's never had apartment buildings go to 75% or less vacant. And he also owned office buildings. And as he said, if the law firm moves out of my office building, I go to zero. So multifamily is always a very good and safe. And also, I think individual investors can understand multifamily better, the dynamics of multifamily. Is Amazon going to take over the world? I don't know. It seems like it, but it's harder to understand that. Will work at home be 5%, 10%? What happens if it's 20%? It's hard to say right now, what demand of office space. Will we go back to the movie theaters? Yes. Will it be or will we all start watching it Netflix? I don't know. It reminds me of a drive-in movie theater that I saw 30 years ago in Cape Cod, Massachusetts, and it was for sale. And I said to myself, I should just buy that and hold it because it was cheap. And now people actually go to drive-in movie theaters for concerts and for movies. So it's so hard to predict some of these things. So I would think those two areas, certainly hospitality and retail and multifamily.
Jay, let's wrap up with 3 sign-off questions, if you don't mind. I ask everybody the same questions. I'll modify them slightly. But we normally I talk to people about digital marketing, but we haven't touched that today. So let me ask you this instead. What daily habits, these are kind of, quick fire questions just to finish up with. What daily habits do you have that make you successful?
Boy, well, I would say the number one daily habit I have is that I do not look at my email past the time I go to bed. So whatever time I go to bed, that's the last time I keep my phone and my devices in a different area. So whether I get up at 3 o'clock in the morning, 4 o'clock in the morning, or 9, just doesn't matter. I generally will return all of my emails prior. That's the first thing I do. And obviously, if there's any voicemails, I don't generally call people at 4 in the morning, but I will send them an email because I pride myself on being responsive to whatever response. And I think you and I kind of did that too. We got together pretty quickly. So that's number one. The other thing I do is I read and read and read. And so, I start with the New York Times, and then I switch to the Wall Street Journal. And then I also carry just about every news organization in my Twitter feed in all the real estate ones. So I see the headlines that come through Twitter from the point of view of anything of interest I have, and then I'll click through and obviously read that. So those are 2 of the things. The other thing that I also think has made me more successful in the latter part of my career, I also tend to either run every morning for at least 30 minutes or meditate for at least 10 minutes. And I'm finding that both of those 2 things have actually helped in making me successful.
Yeah, and this is really tough at the moment. It's good advice. I mean, even especially now.
Exactly.
And we're all so isolated to have these. By the way, just on the Twitter now, it's 2 more questions, just sure. 2 more quick questions. But I wanted to mention Twitter lists. I love the lists that you can create. Different topics so you can drill down. And I'll tell you something, this weekend, I started to try and assemble one that was strictly humor, actually, because I'm finding that having a good laugh is a really good way of dealing with all the nonsense that there is at the moment in all kinds of ways. But I wasn't actually able to find that much. So if you've got any good suggestions for good, humorous,
I don't follow too many comics or people, that, so I really don't.
Just having a good laugh anyway. But if I can put one together that's good, I'll make it public. So far, it's just private. Second question. What's been the hardest lesson you've learned in real estate?
The hardest lesson I'd say, which is also a lesson in life, is never say never, because you just don't know. And try hard not to say never to yourself or no to yourself. So the example I always use is that, pick up the phone. You just don't know what will happen. Go visit someone. You just don't know what's going to happen. I was lucky when I was starting my career. I worked for a gentleman that said to me, if someone has 5 minutes to talk to you, you have 5 minutes to talk to them. Now, today, it can be email. Today, it can be much different ways. So I would say that's the best lesson I've learned. Plus, the other thing I've done as I've gotten older in my career is basically delegate to people that work with you or for you and walk away from it and let them make their own mistakes. It's very important because at some level, if I have to do it myself, then I might as well do it myself. But if you need to leverage out yourself with good people and really, let them run with it.
Delegation's not an easy thing to do.
No.
Actually, it takes some getting used to. All right, last question, Jay. Advice for somebody, big question actually. Advice for somebody looking to invest in commercial real estate today? What would be advice you would give them?
Boy, well, let's start with advice on investing in commercial real estate. And are we talking more individual in general or both?
Yeah, I guess however you want to take it. I mean,
Okay,
my angle is crowdfunding. So
sure.
individuals who are looking for deals, I suppose.
Well, two things. Staying on that, on the individual level, if you have no expertise in investing or owning or managing or leasing or maintaining commercial real estate, you're probably best doing it through crowdfunding, through REIT investment, where you have professional people that's what they do every day. The best example I can give you is I am a licensed real estate broker, which is great, but I will not help myself find a home because I don't know anything about homes except how to live there. And so the advice I give is that, it's easy to watch television. It's easy to, see things and say, okay, I'm going to go buy a 6-plex apartment building and manage it yourself. And then I'll come to you and go, well, what do you know about zoning? What do you know about environmental? What do you know about landlord-tenant laws? What do you know about cash flow? What do you know about any of that? Who are you going to call to get a loan? So that would be my advice on an individual basis. And certainly, look, there are people that have invested individually and made millions and billions of dollars. So, Sam Zell started with very individualized investments and now, is one of the wealthiest men in the world. On an institutional level, it really depends on your money. It depends on your money and something that a good economist once said to me, and your time horizon. If your time horizon is forever, which some institutions have a time horizon of forever, I would start looking to buy and buy and buy as much as I can over the next, I'd say 1 to 3 years in whatever product type I felt comfortable or whatever geography, because it might be one of the best buying opportunities we're ever going to see. So it's because it's of the discounting caused by the disruption. Now, if your horizon is forever, if your horizon is much shorter, at some level, you maybe want to team up with somebody that has a longer horizon and maybe then, have the ability they pay you a preferred return or some level of return over that short period of time, and then they can take you out or something like that. So it really depends on time horizon when you get to what I'd call more institutional or more sophisticated investments.
Jay Olshonsky, NAI Global President and CEO. Thank you very much indeed for your time with me today.
Okay. Take care.
That was Jay Olshonsky, President and CEO at NAI Global. You can find links to Jay and to NAI on the podcast page at garcrowd.com. And if you enjoyed the episode, would you be so kind doing me a small favor and leaving an iTunes review on Apple Podcasts? There is a link on the podcast page to today's episode to Apple Podcast, where you can also subscribe to the series so you don't miss any of the future episodes. Reviews are apparently really important in helping others find the show, and I would be ever so grateful if you have a minute to leave one. And you know what? Let me know if you do, and I will give you a shout out on a future episode, right? All right. Anyway, so if you don't mind, that would be really great. You will find links there on the podcast page at garcrowd.com. That's it for today's episode. Thanks for listening. And thank you, Jay Olshonsky, President and CEO at NAI Global, for your time with me today. It was a real pleasure meeting you. Thank you. That's all for this episode. I'll see you next time. And in the meantime, stay well. And for now, this is Dr. Adam Gower signing off.